This is section 15, target setting. Most of the questions are theoretical. Let's start doing them one by one. And we will do it here, no need to go to Excel. So 15.1, it says all of the following except one are sound principles for devising objectives. For devising objectives in order to enact the corporate mission. In order to create the corporate mission, which is the exception, which means that which is not the sound principle for corporate mission, which is not the sound principle. Number one, they should be observable or measurable. Yes, your goals and your mission should be observable and it should be measurable. If it is not measurable, how could you measure your performance? How would you decide that you have achieved it or not? So any goal, any mission should be measurable. Number two, they should be easily achievable. Easily achievable, actually achievable, they should be achievable. It should be achievable. But the word easily is not proper. I mean, it is not necessary that they should be easily achievable. It could be tough, it could be challenging. So this probably looks a doubt. I don't like this sentence easily. Let's read the other one. They should relate to specific time period. Yes, time period should be there, measurable they should be, and they should be specific, exactly. So this is answer. This is wrong. So we have to pick up the wrong answer. I mean, something which is not a principle. This is principle that your goals should be measurable, they should be time specific, and they should be specific. So this is not, because easily achievable is not a criteria. Easily achievable is not a condition. This is wrong and this is our answer. And we have to look for the wrong option. So 15.1 is done. Let's see 15.2. It says in order for a business strength to have a real benefit, it has to be linked to critical success factors. What are critical success factors? We talked about, CSF, critical success factors, and how to measure critical success factor through KPI, key performance indicators. Critical success factors are those factors which are important for your success. And I'm sure that when you watch that video, for example, we gave that one example, we said that for McDonald's, fast delivery is one of the key success factors, because people, they go to McDonald's for fast delivery. You do not expect that if you go to McDonald's, you give order in 30 minutes, you wait. You can wait 30 minutes for some other restaurant, but not for McDonald's. So their critical success factor is fast delivery. And how do they measure it? They say, okay, we have to deliver food within 7 minutes. So 7 minute is KPI, key performance indicator. So how do they measure? For example, your success factor is fast delivery. Then are you achieving it or not? That you measure through KPI. So you set your KPI 7 minutes. And when you achieve 7 minutes target, it means that you are achieving your success factors. So this is, I just explained to you a little bit theoretical concept. Now we go back to the question. It says that in order for business strength to have a real benefit, it has to be linked to CSF. What are critical success factors? So the critical success factors are factors contributing to reduce cost, not necessarily reduce cost. It is not necessary. Factors necessary to match strengths to opportunities, also not necessary. Factors necessary to build on strength, again, not necessary. Factors fundamental to strategic success. This is strategic success, because this is the answer, that these are your critical success factors which are fundamental to strategic success, which means that without these critical success factors, you cannot achieve your success. Your success depends on them. So D is your answer. They look, all four options, sometime when you are student, you are doing it for the first time, so it looks like that, okay, they look quite similar to each other. But when you start paying attention to the wordings, like it says factors fundamental to success, those factors which are important or fundamental for your success, they are called critical success factors. You see the name says critical success factors, which means those factors which are linked or which are important for your success. 15.3, in general terms, which of the following elements should organizations include in their mission statement? So in general terms, it's important because mission is not something which is like absolute law. Okay, it's a subjective thing. But generally, what should be included in that? So it is not a hard and fast rule. It is not always necessary, but generally, what is included in the mission statement? So number one, policies and standards of behavior. Yes, generally companies they include it. Values, a description of the culture, assumptions, and beliefs regarded as important to those managing the business. It is true. Profitability, no. It looks very, mean to mention profitability in your mission statement. Strategy, the commercial logic for the business, defining the nature of the business. Yes, it is also true. So this is your mission statement, 1, 2, and 4 only. I pick up this one. Profitability definitely is not. So any option with 3 is gone. 15.3 we did. Now we do 15.4. Which of the following short-term objectives may involve the sacrifice of long-term objectives? So in business, you do have short-term objectives. Short-term objective could be your profitability at the end of the year, and long-term objective could be your innovation and new product development, etc. So which of the following short-term objectives may involve the sacrifice of long-term, which means that if you want to achieve short-term, maybe you have to sacrifice the long-term objective. So which are those short-term objectives which will require long-term objective sacrifice? Reducing training cost, increasing quality control, increasing capital expenditure projects. This is actually one only. Why? Like, for example, it says which of the following short-term objectives may involve the sacrifice of long-term objective. Reducing training costs, like when you, in order to achieve your profitability in the short run, you actually sometime stop spending money on training. And training is your long-term objective, to increase the capability and capacity of your people. Companies, they invest money on their staff, on their employees, and that money is called training cost. And businesses, they have huge budget for training their people in order to make people more efficient. So it is very common that sometime when businesses want to achieve higher profits in the short run, they stop spending money on training. They say, okay, training, no problem, it's not essential, let's not spend money on training this year because we have less profits, we will do training next year. So this is one, reducing training cost. Increasing quality control actually will increase the expense and decrease the short-term objectives. And the same happens with capital expenditure. If you start spending more, then this short-term objectives will not be there. So these are not related. Number 15.5. What is short-termism? It is when non-financial short-termism, which means that you start thinking for short-term objectives. Short-termism means when businesses try to achieve things in the short term, they focus more on the short term and they ignore the long term. So it is when non-financial performance indicators are used for measurement. It is when organizations sacrifice short-term objectives, not sacrifice. Actually, this is exactly opposite. Because in short-termism, you sacrifice long-term objectives. It is when there is a bias towards short-term rather than long-term performance. It is when managers' performance is measured on long-term. It is also opposite. This is our answer. It is when there is a bias towards short-term rather than long-term. It means that you start giving preference to your short-term goals. You start giving more importance to the short-term goals and less to the long-term. This is called short-termism. So when you are like, when we say that the business is acting short-term or short-termism, it means that the business is focusing more on the short-term objectives and short-term achievements and ignoring long-term. So this C should be the answer. Then we talk about 15.6. It says which of the performance measures in the top-down menu, top-down list below, is most likely to be recorded because of government regulations. Which of the performance measures is most likely to be recorded because of government regulations? Performance measures. So which performance measures you are recording because of the government regulation? Sales growth, it has got nothing to do with the government. The government never asked us to measure sales growth. Customer numbers, it is also not related to government. Return on investor, also not related. CO2 emission, carbon emissions, this is government regulation. Government will ask you to control your carbon emission. Government will ask you to protect environment. So this is one performance measure which you will start measuring because of government regulations. Other three are commercial. They are investor related. They are not government related. Very easy question. 15.6. 15.7. Which conditions and economic conditions, market conditions and economic conditions can impact on performance measurement? Which of the following statements are true? Okay. Market conditions and economic conditions can impact on performance. So your market conditions in which you operate and the economic conditions in general, they can impact on performance measurement. Okay, so which statements are true? Number one, the entry of a new competitor in the market will cause a business to examine sales performance measures more closely. Yes, definitely, whenever a new competitor comes in, a business must pay attention, very close attention to its sales performance. And general economic conditions can raise or lower overall demand and supply. It is also true if the economic condition is improving or or the economy is in depression, it can change the demand and supply. This is also true. We can say one and two are true. So both are true. Both statements are true. 15.8. Which of the following best explains the relationship between mission statement and performance measurement? Best explain the relationship. Mission statements are a marketing tool and have no part to play in performance measurement. No, that is wrong. It's not a marketing tool. To be of value, mission statement and to be of value, a performance measurement must have an obvious link to this link. No. Must have an obvious link to the mission statement. It's also not true. It is not possible because all of the performance measures, they cannot be linked to mission statement, because mission statement is a very broad term and performance measures maybe are very specific. So it is also not true. Performance measurement involves comparing actual performance against a target, and the mission statement represents the organization's overall target. That looks quite correct, but let's read number 4 also, and then we make a choice. Mission statements include detailed performance standards? No. Mission statements include detailed performance standard? It never. Mission statement is a 4-5 line of statement. It does not include detailed performance standard. So I do not even need to read further. This is wrong. Your option is C, because it looks better. Mission performance measurement involves comparing actual performance against a target, and the mission statement represents the organization's overall target. Mission statement is your general overall target, not specific standards. Option is this one, C option, 15.9. Then we do 15.8 we did. Now we do 15.9. Which of the following describes the role of tactical objectives? You remember that tactical are at the lowest level. So no, tactical is the middle one. The top one strategic, then tactical, and then operational. Operational was at the bottom. We said that we made this type of pyramid. This is corporate or strategic. The middle one is tactical, and the last one is operational. So which of the following describes the role of tactical objective? Middle tier objectives to facilitate the planning and control. This is the answer. Day to day, it is your operational thing. A clear vision of the organization, reason for existing, this is your strategic. This is also strategic. These are the two top layers. This is the bottom layer. This is the middle layer. 15.10. A company sells new high quality motor vehicles in many countries around the world. Halfway through the company's current financial year, the global economy unexpectedly goes into recession. So during the year, your economy has gone down. So what will happen? What impact would the unexpected recession have on performance measurement relating to sales and revenue? So what will happen to sales and revenue? Number one, the impact of a recession on the sales of new high quality motor vehicle cannot be predicted. Cannot be predicted. No, it can be. It's not the answer. Sales and revenues are likely to decrease in the second half of the year and performance should be measured in that constant. Yeah, this is the answer. Because in the middle of the year, halfway, global economy has gone down and you actually are preparing some high quality motor vehicles. So definitely it's a durable good. People will stop spending on new cars. People will stop buying on the new cars. Sales revenues should go down. And based on the new economic condition, you should redefine your targets and you should remeasure your performance. No impact as recession is unlikely to impact, it is wrong because your product is high quality motor vehicles, expensive cars. When economy is going down, nobody will buy expensive cars. So this statement is wrong. Number three, wrong. Sales and revenues are likely to increase. Of course, it is not possible. How can sales increase in this period? Your answer is this one, B option. 15.11, the last one, I think. Or do we have more? Let's see. Which of the following describes the role of strategic objectives? Strategic objectives. So middle tier, no, middle tier are not strategic. Remember that strategic is on the top. This is called strategic part, corporate objectives, corporate strategy, strategic, and these are long-term things. Day to day, it is also wrong. This is also wrong because this is middle tier, this is operational, this is middle tier. They ask us strategic. Strategic has to be this one on the top. So day to day is not answer, middle is not answer. A clear vision of the organization, reason for existing. Or long-term objectives for the organization as a whole. So what you should pick up, you should pick up your long-term objectives because they ask us strategic objectives. So strategic objectives are long-term objectives for organization as a whole. A clear vision for the organization's reason for existing. It is not strategic objective. It could be your vision statement. It could be your vision or mission statement, but not strategic objectives. Strategic objectives are these one, long-term objectives. Then 15.12, the following statements relate to benchmarking. Which two statements are correct? A danger of benchmarking is that inappropriate comparisons lead to incorrect conclusions. Very much true. Because in benchmarking, what you do, you take a model business, you take a model company, and you start making comparison with that, and you start, making your business a replica of that business. For example, if you want to, start fried chicken business, a new business has fried chicken. So what do, you keep KFC in your mind. You have KFC as your benchmark, and you say that I also want to become KFC, for example, or my quality should be as good as KFC, or my taste should be as good as KFC, because KFC is the market leader. So if I also produce the same product with the same quality and service, I will also be successful. So you take KFC as your benchmark. So this is benchmarking. We say a danger of benchmarking is that inappropriate comparison lead to incorrect conclusion. If you start making incorrect, inappropriate, unsuitable comparisons, of course, your conclusions will also be incorrect. So statement number 1 is true. Then statement number 2, which one is, benchmarking must involve competitors to be effective. No. It's not true. Benchmarking must involve. You don't involve it. The ultimate aim of benchmarking is to improve performance. Yes, this is true. Why do you keep KFC as your benchmark? So that you improve performance. Performance in food quality, performance in price, performance in delivery, performance in your operations, and so on. Benchmarking is essentially a cost-cutting exercise. No, benchmarking is not a cost-cutting exercise. Benchmarking has got nothing to do with cost-cutting. So first and third, these are correct. 15.13.
Very simple and
A financial services company benchmarks the performance of its IT department with that of a leading IT outsource company. So what type of benchmarking is the company using? So it's not strategic. What are they doing? The company's financial services, probably an audit company or a financial consulting company, and they have internal IT department. And what do? They start taking outsourcing these services. So they just say that, okay, we don't have to have our own IT people, 1 or 2 staff member, let's outsource the IT. So it's not a strategic, it's not competitive, it is functional benchmarking. Functional. So what they are doing, that for one department they are doing it. It is called functional benchmarking. 15.14, company A manufactures mobile phones. Staff employed within the research and development function at company A have purchased a mobile phone manufactured by company B for the purpose of reverse engineering. They want to see what their competitor is making. So it is very common that these companies, they buy the product of their competitor and they analyze it, and they see that how they have made the product. So what type of benchmarking uh, they are doing? It is called comparative benchmarking. So they are not changing their strategy, business strategy. They are just analyzing their competitor. It is called comparative benchmarking. Then 15.15, which of the following are suitable measures of performance at the strategic level? Strategic level. So machine idle time, strategic level is the top level in the company, okay? So machine idle time, it is operational, it is at the bottom level. Employees sick days, also not important. Yeah, this is return on capital employed. This is the investor's point of view. This is investors, performance measurement. So three only is the last one. This should be your answer. So that's all. I think just one last one we do and we finish with this 15.16. Again, it's very simple. What is short-termism? So short-termism is, prioritizing short-term results over organization's long-term objectives. objectives. This is short-termism. We know the definition of short-termism, when you give importance and priority to short-term goals. So that's all with this chapter. Quite simple and easy.